Hello, this is Rich Vessel, founder of Advanced Projections, with our October 2023 economics report. First, I want to start out with a quick note. Next month's report, the November report, will be delayed until just after Thanksgiving as we await the formal FOMC meeting minutes and new leading economic indicator data, which are both published near that time. Thank you for your patience at that time. Now, AP reviews the economic data highlights for September and early October of this year. Employment figures for September came in with another hot new jobs figure, up 336,000, with unemployment remaining at 3.8%. We still expect unemployment to gradually move upwards. At these levels, we continue to expect the Fed staying fully focused on inflation, given this low unemployment as permission for further rate increases if necessary. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. And we have a couple of charts which we've used the past couple of months, demonstrating the patterns of behavior of unemployment claims and unemployment levels just ahead of recessions. The annual CPI inflation through September was announced on October 12th with the actual reported value of 3.7%, 0.1% above expectations. Additionally, the core CPI that leaves out volatile food and energy prices was still 4.4%, and sticky price inflation less food and energy continued high in September at 5.5%, which is still about 2% higher than the more generally watched headline CPI number. As oil prices have gone up again over the past 2 months, recently breaking above $90 a barrel and hovering in that territory, it will likely be adding to the CPI headline inflation numbers in the months ahead. Federal Reserve FOMC again paused their rate hike program in September after increasing their Fed funds rate on July 26th. So this key interest rate remains at 5.25% to 5.5%. We had expected them to implement another increase as inflation and employment numbers in from August provided prompts to do so. Since they declined to raise rates this month, it is highly likely they will raise rates once more in early November or mid-December within their next 2 FOMC meetings. To this end, they've issued a new set of dot plot projections for 2023 to 2026, and they've again projected a longer fight against inflation with higher rates for a longer duration than they had previously indicated only 3 months ago. The continuing solid employment picture is likely to confirm that scenario. In June, the Fed essentially promised 2 more rate hikes in the second half of 2023, and July delivered the first of those 2. Now it's just a matter of when the next one arrives. We tend to gravitate towards early November, given recently increasing oil prices and upticks in inflation. The S&P 500 remains overheated. The bond markets reveal that smart money is still paying more attention to the Fed's signals and pronouncements. A small pullback in September has continued here in the first half of October. Note, in early July, our proprietary equity EKG showed extreme overconfidence, even more so than in the fall of 2021. This is usually a sign of a major market top within 1 to 3 months of that reading. With the S&P 500 and the NASDAQ down about 2% during September, recent market behavior in early October is again showing index price weaknesses coupled with high overconfidence. This week's FOMC meeting appears to have stuck a pin in the confidence bubble, and we expect further declines through the end of 2023. Our leading indicator system keeps our recession risk level at 90% due to still declining leading economic indicators, continuing hawkish Federal Reserve monetary policy signals, and ongoing red AP indicators. 3 of our 6 indicators are just barely showing yellow, and the other 3 are still solidly red. Now here's the current underlying economic details. Year-over-year consumer price index increases and tight labor markets continue to characterize our economy. General expectations out just ahead of this September's CPI announcement were for 3.6% year-over-year inflation, and it came in just a little higher at 3.7%. In July, the Federal Reserve completed the first of 2 rate increases promised for the second half of this year, as the underlying sticky inflation numbers are not coming down as rapidly as they would like, and employment has not yet turned into a real negative trend. Consumers are still spending and have accumulated record amounts of credit card debt, now exceeding $1 trillion. Bureau of Labor Statistics reports that unemployment continues to remain well below 4% over the past year, now at 3.8%, with a solid new job gains figure in September of 336,000. We had expected those gains to dwindle faster in the first several months of this year, but there is still no strong evidence of a backslide in employment at this current time. We do have the BLS table, Household Summary Data Table A, which is always included in our report, and it shows that all employment numbers are still higher than a year ago, including the labor force participation rate and total numbers of employed persons. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, right along with their 12 rate increases in the March 22 through September 23 timeframe, and within their last available FOMC minutes. In the energy picture, OPEC and Russia had recently agreed to additional production cuts to support prices for their oil. The markets responded by gradually moving oil up over $91 a barrel, then it retreated slightly to about $90. We'll keep an eye on global demand forecasts to see where oil could go over the next several months, but our expected volatile price range for the next several months is $75 to $95 per barrel. Gasoline prices in the USA have defied the overall increase in oil prices and remained in the lower $3 zone in most areas over the past month due to reduced demand and plentiful supplies. However, we do not see that holding up for much longer. If oil holds near $90 for any sustained period of time, $4 gasoline is back on the table for a while, which will then add into consumer expectations for inflation. There is a lot of yin and yang in the market forces that determine natural gas prices, but for now they have generally declined significantly from high levels seen at the end of last summer, and I mean summer of 2022. As of this writing, Henry Hub prices are down just over 50% from the same date last year. Production has clearly overtaken demand again, and even with the U.S. exportation of record amounts of liquefied natural gas in the past several months, pricing has still gone down. These lower prices should also relieve electric power production costs, as natural gas accounts for about 40% of the U.S. generation mix. Winter heating bills for gas users will also be significantly lower than last year. The first 6 months of 2023 saw solar and wind power generate more electricity than coal did, as coal-fired generation declined further, with renewables and gas-fired plants making up the difference. Gas has provided well over 40% of America's electricity over the past 3 months, and renewable generation has also increased. Coal is expected to be only 16% of the power blend this year, declining to 15% or less next year. Now, interest rates and Federal Reserve analysis of that picture. The new Fed rate pause this month has not been met with the same stock market enthusiasm as we saw in June, because the Fed now projects higher rates lasting well into 2025. Their projections, released with this month's FOMC report, shows increased expectations for rates in 2024 and 2025, each year up over 0.5% what they had projected just 3 months ago in their June quarterly statement. Additionally, the consensus amongst the voting members appears to evaporate for 2024 and 2025, with a very widespread set of expectations amongst those members. We at AP continue to expect a few more interest rate increases. One of the FOMC's voting members actually expects 3 more 25-point bumps. The rest generally say 0 to 2. We expect they will be accompanied by further general declines in equity and bond prices in the intermediate term of 2024 and 2025. A return from the current index level for the S&P 500 to just below bubble territory back to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 3100. Downside momentum selling could take the index down much more if panic sets in. The Fed states that they are still highly resolute in their attack on inflation. That means significant rate hikes should still be expected. They have clearly stated what their targets are, that inflation has only slowly and so far just partially responded as needed, and they are dead set against significantly pausing or ceasing their program too early so as to avoid the mistakes last made in the 1970s. The more intransigent portions of inflation still have yet to be tamed. In the same reporting period, sticky inflation minus food and energy only moved up very slightly to 5.5% and is still up over 2% in the past year. This is not a good sign, and the Fed reflected it in their updated estimations for 2023 through 2025 interest rates. We look for continued small increases when the Fed FOMC returns with its next steps this fall. Their January through September rate increases were below our expectations, but based upon their newly issued September report, we do not expect any delicacy or wavering on their part here in the rest of 2023. Expect at least one more 25 basis point bump yet this year, either in early November or in mid-December, if there are no unwelcome surprises during the early fourth quarter for this year. The Fed's own algorithmic prediction of recession follows the yield curve inversion that we watch as it rapidly increases. Last November, there was an initial movement over 40% probability, which is a historically accurate red flag for a recession centered about 1 year later, after reaching that 40% mark. Our enhanced APFD indicator has been red ever since the Fed's indicator moved solidly above 40%. We have added that trigger level to a recent chart from the Cleveland Federal Reserve that illustrates where recession potential now lies based on the Fed's calculations. With the Fed funds rate at 5.25% plus, it is still somewhat below our expectations for the year to date. Our APYC yield curve indicator's negative spread magnitude continues to remain wide, and it is expected to remain red for many months ahead. This particular spread, which we have been using since our inception in 2013, was recognized by the Fed in 2018 as being the one to watch for true curve inversions and the most timely recession indications. This spread maxed out at nearly minus 1.9% at the end of May, just before the first Fed pause. It ended September at minus 0.96%, and is currently near minus 0.62%, which is still implying a recession ahead. The Fed chart we showed earlier above says that their own methodology strongly agrees. We also feel that it is entirely within the realm of possibility that the Fed will raise peak rates to 6% by the time it is finished somewhere in 2024. Now for a review of the equities markets. September's closing value for the S&P 500 was 4,288, down 219 points for the month, thereby tipping our APSI indicator slightly upward into yellow territory because of a slightly reduced risk level and slightly reduced growth levels. Due to the character of our algorithms, a close for October at or below 44.50 will bring back a red indication. The markets demonstrated increased volatility when the September CPI 3.7% inflation number that is most widely and incorrectly watched came higher than expectations. While battling with hopes for improved third quarter earnings here in the first half of October, September's 336K new jobs, along with low expectations for a November Fed rate bump, has so far failed to ignite new excitement for the equity indices. For the third quarter of 2023, we are seeing various earnings estimates for the S&P 500, which are centered around very small gains of 0.5% to 1.5% over the same quarter of 2022. It is most likely that the energy and financial sectors, in particular banking, will be responsible for the bulk of any gains, as higher energy prices and interest rates are driving higher earnings for those who are in the specific businesses of energy and money lending. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets, and the breakdowns in this metric, which usually appear ahead of real economic downturns. In August, for the first time in 4 months, margin borrowing declined by 2.9%. September saw a further decline of 1.2%. This form of risk capital has clearly made some serious exits from the markets, down about 40% from its recent peak. An equity market bottom could be near on a historical basis when margin borrowing declines a full 50 to 55% from its previous high. So there is still the potential for a further decline of around $110 to $150 billion to realize the full decline from the last high of $1.03 trillion in margin borrowing. Our estimate for a bottom in margin borrowing is illustrated in the markup of a chart that we have been using from the courtesy of Advisor Perspectives. And it illustrates where we expect to see both the S&P and margin borrowing finally terminate somewhere in the 2024 to 2025 region. We also have a long-term historical chart, also courtesy of Advisor Perspectives, that continues to point out how risky the U.S. equities markets still are. The chart shows where investment risks in the S&P 500 went during the last great inflation fight, 1970 to 1980, which took far too long as it included premature program halts and restarts by the Fed. We marked up the chart with some risk zone labels in green and a target risk landing zone in green as well. This should give some perspective insofar as outlining how much farther the equities markets could correct before conservative investors can prudently consider significant re-entry. The base zone around minus 50% risk level is where equity valuations bottom historically. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.